One of the things that we keep a close eye on when it comes to managing risk for our clients are credit ratings. So let me tell you first about where I think things are going from here. We are about to hit 1.5 million confirmed cases of COVID-19. We're now starting to see reports coming out over the credit rating agencies changing or possibly about to change the credit ratings on various sovereign nations around the world, and undoubtedly corporations as well. As an example, we've just seen in the Southern Hemisphere in the last couple of days, Brazil's trending from positive to stable with S&P. We've seen a possible downgrade coming for the country of Australia, which has a AAA credit rating. And today, Argentina had selected default on their outstanding bonds. I remember this when we went back to the financial crisis, seeing a number of sovereign nations seeing their credit ratings being downgraded. Why is this important? Well, it does two things for you. One is it tells you a trend that's happening around the world. And two, there's an actual financial cost that comes to these countries and to companies as their credit ratings are downgraded. Now, the credit rating agencies lost a lot of credibility in 2008. If you watch the movie Big Short, you'll learn why. Basically, you had companies paying the credit rating agencies to provide them with credit ratings. So if the credit rating agencies didn't give them a favorable credit rating, those companies would probably stop paying them. And so it was this conflict of interest, which actually still exists today. But I think that what's happened is the credit rating agencies, of course, have had to improve their act because they lost a lot of, ironically, credibility during the era of 2008, 2009. So that was global financial crisis of 2008, 2009. Here we are, 2020, amid this health crisis that's converting itself into a financial crisis fairly quickly. So let's recap what credit rating agencies do, who they are, and how they work. So first of all, they're not owned by governments. They're independent companies. There's four major ones that we here in Canada follow. The big four, of course, are S&P, the largest in the world, followed by also Moody's and Fitch. And then here in Canada, we have DBRS, or now known as DBRS Morningstar, as Morningstar, the US company, has recently purchased them. Credit rating agencies they provide credit ratings on debt issued by sovereign nations, as well as institutions like provinces and states, cities, other organizations that are publicly funded, like Export Development Corp or Farm Credit Canada. And then finally, you also have companies, financial institutions, and just regular plain old public companies who are out in the debt market borrowing money. And in order to get cheaper borrowing, they go to the credit rating agencies to hopefully get a favorable credit rating. Now, those credit ratings have two types of terms. They have short-term credit ratings and long-term credit ratings. So general rule of thumb is that a short-term credit rating is based on any debt instrument, like commercial paper, bankers' notes, that have a maturity term of a year or less. Most people don't really tend to pay attention to the short-term credit ratings. People will often refer to AA, AAA, single A, triple B, and that's long-term credit ratings. So that's what people are more commonly familiar with. And each of these credit rating agencies have their own methodology, but they're all generally about the same. Now, the credit rating agencies also provide a little bit of forecasting as to where they're moving on those credit ratings. So as I mentioned, for example, today, the big news was that Australia has just gone from stable to negative on their AAA credit rating. So typically what happens is a credit rating agency, like in this case, S&P, will give the market a heads up that, hey, you know what, based on the way things are unfolding with COVID-19 and the economic impact happening for this in the country of Australia, we are tending to head towards changing their credit rating from AAA, which is the highest credit rating. It's considered to be zero risk. It's the highest credit rating you can possibly have, to the next highest, which in their case would be AA+. So as the COVID-19 pandemic develops, continues to unfold going into the spring and potentially the summer, we're going to be keeping a close eye on what these credit rating agencies are saying. Now, we don't trust them, their word completely. That's why we do our own independent research here on our team at Canaccord Genuity. But it is going to be a very good gauge to make sure that we are keeping track for our clients, both equity investing clients as well as fixed income investing clients, cash management clients, and clients that are investing in their private wealth portfolios, to make sure we've got a good finger on the pulse as far as what's happening in this market. If we start to see credit rating agencies aggressively downgrading sovereign nations, provinces and states, other publicly funded institutions, as well as banks and corporations, it's a very big red flag for us to see. Now, it can also mean opportunity. One of the things that we're seeing on the street right now is a resurgence in distressed debt funds, for example. If you start to see information like this come in, if you hear that on the news, that tells you that the credit rating agencies are starting to really look at a negative lens on these institutions. And it can mean some great opportunities to invest, but it also means there's some troubled waters ahead, and you need to be aware of what that means and know how that will impact your investment portfolio. If you'd like more information about this or some advice from our team, we're here to help you out. Just give us a phone call and we'd be happy to assist. Thank you.